So this session is best practice on how to lead an investor towards impact, and it's going to be led by Adam Bendel. Adam is the CEO of Tonic. He is my boss. That's why I'm on my best behavior today. Adam,
do I look like her boss, or does she look like mine? Huh?
Adam is a well-known entrepreneur, innovator, and he has written some amazing pieces on this whole transition from traditional investing into impact investing. So I would urge you all, if you want to get some deep insights into this field, to just Google Adam's name. And Adam, I welcome you to moderate the session.
Thank you, Kanini. I'm good, I think. I'm loud. And I, by the way, am one of the people in the room who will be happy to defend my identification as an impact investor and everyone else. I think it's actually a term we can be proud of and not scared of, given what the trends that are happening in the world. And today I have the pleasure of moderating a panel of distinguished gentlemen, all gentlemen in this case, though we tried to mix that up a little bit, who have moved both capital and their own 2 feet. They have led in extraordinary directions in different ways, as you will soon hear. The relatively large institutions that they've been involved with in the direction of a sustainable future, a green future, and thereby demonstrated that many people in the space are not just talking, but acting, but doing. And so we have an opportunity here to be incredibly inspired by what these gentlemen have done. And so we have a relatively short amount of time, and so I'm going to actually ask them to each introduce themselves rather than my doing so. So I'm going to ask you each for a kind of brief introduction of yourself, and then to tell the audience here kind of what was your tipping point. You know, what was it that caused, was there a moment, or was it a gradual awakening where you reached the conclusion that business as usual was not going to be sufficient to solve the world's problems and deploy capital to do so? And what caused you to reach that conclusion? And then very briefly, what have you done about it? We'll go back to that in a little bit. So can we just go down the line? If I can ask you to, please, Philippe.
Okay. First, I'm very happy to be here. I think it's a great moment, and we are participating to something much bigger than we even think now. I started as a civil servant in 1985 at the French Treasury, not a place where unorthodox thinking was very common at that time. And 12 years later, I went to the private sector, working for AXA, and then after for an American pharmaceutical company. And for the last 10 years, I was the CEO of a French pension fund, ERAF, a mid-sized pension fund with 30 billion euro asset under management. The tipping point for me was when I joined ERAF, the first review of our investment portfolio. I realized that we were invested up to 27% in financials. I say, wow, how can that be possible when there is this big financial crisis? And I realized that we were just replicating the index. Because my team said, no, that's just the index. I say, I cannot believe that. And they brought me the index, and I say, okay, you're right. And I realized that there was something basically fraught in our way to invest, because we were just replicating the world as it is, when I was starting to realize that everything that I have been believing in was not true. For example, the basic assumption of the efficient market theory were proven wrong. at the very moment I was joining. And it reminded me something that was said by Herbert Stein, an American economist, who said a long time ago, what cannot go on forever will stop. And I realized that, it was much beyond finance. It was also about sustainability. And as the CEO of a pension fund, I realized that we were on a path of unsustainability. And when I joined ERAF, there was already a charter for implementing a sustainable, a responsible investment policy. And I adopted this, which was already in place. And I just tried to push it forward and make it something that was really embedded in everything we would do then after. And that was the start of a very long journey that led me to get more and more involved with the years coming by.
Thank you, Philippe. Jan Stahlberg.
Well, I grew up a very poor boy. When I was a kid, I lived largely by myself from the age of 7 and had to go to my cousins to get food and clothes. And I was very lucky at the time because I grew up in Sweden. And if you're a reasonably talented boy working hard, you can actually make it pretty good. And I think virtually all of us want to do good in life. And when I was 18, I thought about helping Africa and aid, but then I actually got a scholarship to go down to Africa to look at Swedish aid programs, and I must say the outcome of the Swedish rather generous aid program was quite depressing. So I left that, and then I got to the passion of investing instead, by coincidence really. And the last 24 years I've been part of the team that founded EQT, and we have become, I think, the 7th largest private equity investor globally. We just raised 30 billion in the last 5 years. And for a couple of years, I've been on the Stockholm University panel for looking at the jury for business cases among students. And I think that opened up my eyes that the new generation have realized something that many of our generation haven't really realized, and they will never change. So this is an obligation, but it's also a tremendous business opportunity. And therefore I decided to leave EQT and started Trill Impact with the ambition to build a world-class investor of size. And I hope that in 20 years' time, this will, impact investing, will essentially be everything. I'm using that term proudly, although I do know that the investor community, where fortunately I believe I have some trust after having raised 29 funds over 25 years and delivered okay. So I think in that sense I have one foot in that community, which is not converted like this audience, very far from it.
Right.
But I have some trust in that community, and probably at least I'm growing and hoping to get some of your trust too. But guys like me typically don't have trust even in the impact world, because we are big bad finance. And as we heard from Mr. Rubenstein, there is lots of skepticism in the financial industry. And I believe I have a good opportunity to combine both, because we need to work with the private capital, otherwise we won't solve the problems that Mr. Rockström talked about earlier today. So this is how I got here.
Well, I'm sure I speak for Jochen and Sasha and the organizers of this, that bridge builders are welcome here. So thank you for the work that you're doing. Mats Andersson.
Thank you, and great to be here. My background is that I've been working in the financial industry all my life. 10 years as a business journalist in Sweden, 10 years in investment banking, mainly at Warburgs and Deutsche Bank, heading the Nordic equity operations in Stockholm. Then for 15 years in the pension industry, 10 as the CEO of AP4. I left AP4 2016, some 3 years ago. My turning point came a bit gradually, but I'm a believer that individuals make a difference. And I was convinced by my old mentor, Laszlo Szombatfalvi, turning 92 this year. Some 10 years ago, he started to ask me how I mitigate climate change as a long-term investor. And I said, Laszlo, I don't know if it's for real. Secondly, if it's a problem, it's for the politicians to deal with. So he kept pestering me with questions. He sent articles, books. And finally, I understood it's probably for real. At least it's a risk that I need to mitigate. And when I also realized that if you have a mandate to invest on a 30 to 40 year horizon, sustainability, climate change, ESG is something that you need to address because it is a risk, and if you don't do it properly, you will get hit. So I decided that I don't need to invent the wheel. I went out to see 10 of the world's 20 largest pension funds in 2012, something, and asked them about risk. And they said it was all volatility-based risk. And in my view, volatility for a pension fund like ours it's rubbish. And then I asked them, what's your exposure then to climate change? And in 2012, none of them had a clue. So we needed to invent the wheel. So I went back and I convinced my equity teams to actually try to find a way to do this. And they finally came up with the idea of low carbon approach, where we divested from those worst polluters in every sector. And by doing that, we lower the carbon footprint, we lower the risk. And when I left AP4, I'm proud to say that actually gave us excess returns by doing that. So again, there is no conflict between good returns and dealing with ESG. Thank you.
Thank you. So maybe I'll stay with you for a few minutes, Mats, and ask a couple of follow-up questions. So you said that volatility you think is not a good measure of risk in these contexts. What do you prefer?
No, to me, a risk is a permanent capital loss. And climate change definitely represents the risk of a permanent capital loss. So that needs to be dealt with, in my view.
Did changing to a fossil-free approach change the risk profile of the fund?
Of course it did. Short-term, not really. I mean, short-term ESG is a random factor. Long-term, definitely. And the lower exposure you have to climate change, the lower risk you have. And if you can do that without giving up returns, rather than the other way around, I mean, it's a plus thing.
Yeah. And so how did the long-term mandate change your investing approach?
I would say it changes everything, because what is very odd in our industry, I think that Philippe agrees with me, that you have a duration of your liabilities that are usually between 30 or 40 years, or at least 20 to 40 years. And if you look at the asset side of this, you run the shop by measuring performance on a yearly basis. At AP4, where actually the law says you should have a 30 to 4 horizon when you invest, they still continued to evaluate us on a yearly basis. And if you run a thing on a yearly basis, it's a totally different thing compared to having a long-term horizon. And by finding mandates or defining mandates and finding people who understand the difference between the short term and the long term, we found some extremely good talents that are still with the fund. And I think that we today, I hope you agree, Sarah, can actually have at least almost proven that it does pay off to be a long-term investor.
Yeah. Great.
Yeah, I just want to rebound on what Matt said, because we are really at the core of this issue of long-term investing. There are very few people who really understand what a pension fund mission is all about. A pension fund is here to transfer revenue from today in the future. It's some sort of intergenerational pass-through. So it means that for someone who is 20 years joining a scheme, we will manage money on its behalf for the next 40 years, but much beyond 40 years, because at 40 or 42 years later, it will retire, but hopefully he will live, or she will live 25, 30, 40 years. So we are managing liabilities that are on average with a duration of 30 to 40 years. So where volatility is a wrong approach to assessing the risk is because when you are that long term, the immediate bump in the valuation of your assets does not mean a lot. You know, your stock portfolio is up by 2%, it will be down by 3% or rebound. It does not matter as long as you are in net positive cash flow. And even though you were not in positive cash flow, there would be technical solutions I could elaborate on. But, you know, the solvency approach that has been applied, I think wrongfully, to pension funds regulation is based on this idea that you should calculate a value at risk on a one-year basis. One-year basis when you are managing liabilities with a duration of 30 years. And in the case of ERAF, it was very sad because this scheme was set up in 2005, so we started from scratch. So when you start from scratch, it means that the ramping up period of the fund will last 40 to 42 years. And the regulator made mandatory for the scheme to invest a minimum of 75% in bonds, which seems absolutely wrong, because it's precisely when you have those net positive cash flow, huge net positive cash flow, that you should invest in infrastructure or whatever is making possible to extract the liquidity premium from the market. And, it's absolutely appalling to see that, for example, if you were to invest in Greek debt at that time, you had a standard capital requirement of 0. But if you were to invest in infrastructure, you would be charged 40%. So where is the risk? And to rebound on what Matt said, the main risk is to invest in something that will be worthless at some point. And as I said before, what cannot go on forever will stop. And I remember Barack Obama saying, we won't burn all that carbon. There are not so many things we are sure of, but there is no dearth of fossil fuels on this planet. But we cannot burn all those fossil fuels, because if we were to do that, we would be cooked. And it's not about to save the planet. The planet made without us for billions of years, and it could do without us for billions of years. It's just to save the possibility to live on it. So, I think we have to work on hard to convince regulators to change that pattern and to accept the idea that pension funds being very long-term, being intergenerational pass-through, they should be allowed to invest much more in illiquid assets or in stocks, whatever is related to the productive capital. And for example, some countries did understand that. Japan with GPIF authorized to invest up to 50% in stocks, or Norway, where the sovereign fund, the oil fund, is authorized to invest up to 70% in stocks.
Yeah.
Just a quick one. I think what Philippe is saying, that regulation has made long-term investors become short-term. Mm. And short-term, you're not that well equipped actually to deal with long-term risks. So this is, it's all down to regulation, I'm afraid.
But also internal and external pressures, right? Because when you're facing a market or regulators or all the pressures that you face that are seeking short-term returns, annual performance calculations. So how did you each deal with that, both the internal resistance and the external pressure? Mats?
Good question. Next.
Yeah.
No, I think that once I understood or came to the conclusion that climate change is a risk that we need to mitigate, I asked the equity team, and I mean they were that interested really, because it would make their life more complicated. So the head of equities actually said to the newly recruited guy, could you find a model for this? And this clever guy came up to me some months later and said, Mats, it's a very easy thing to do. Let's get out of fossil completely, which is the right answer to the question. Unfortunately, if I would put that proposal to the board, this is before Sarah got on board, I'm sure they would say no, because short term it's betting on one sector. It could go either way. So I asked Fredrik that you need to come back with a better solution. And he came back and then got this, how you lower the carbon footprint by actually taking out the worst polluters in every sector, and we actually that way got a free option that carbon emission were wrongly priced. And that was easier to sell in. But I mean, I had the questions from the board, can you guarantee? No, I cannot guarantee. Are you sure the numbers are right? No, I'm not sure. What will you say when the journalist from the Daily News calls you when you've lost money? But anyway, they gave me a small mandate to implement, and then it sort of built on that, and one success led to another. Then internally, I have to admit as well, it wasn't an easy sell either. It made cases or made life more complicated. So I had to convince my CIO, and when Magnus and I said we're going to do this. So we will never back away from this. They understood either we do it or we have to get out, more or less. So you need to it starts with yourself, and then you need to use the tools you have. And as the CEO, I had all the toolbox I needed. And if I could, and I did convince my CIO, that sort of combination made it possible to implement. And then some years later, when it turned out to be a success, everyone was supporting it from the board to everyone on ground.
Philippe, what was your experience with that?
Yeah, it's very interesting because we followed exactly the same path than the one described by Mats. And it was absolutely at the same time that we realized that we were benchmarking our performance against an index that was a market cap. And market cap is business as usual. Mm-hmm. So there is some sort of contradiction when you pretend to invest in order to make a change or to speed up the transition, and assessing your performance to something that is precisely the current state of affairs. So what we did is exactly what Mats did. First, it was to get the buy-in by the board and explaining exactly what I said, and working on a way to decarbonize the portfolio. And by the way, we did it with exactly the same asset manager, which was Amundi at that time. So, I mean, the core of the issue is governance. It was mentioned this morning, and it's sad to remind that 60% of pension funds did not have a real charter or guideline on their investment policy on how to align it with climate change challenge.
75.
Yeah, it's absolutely appalling. So at ERAF, fortunately enough, we had a clear SRI policy, and we just started to think about how we could be even more consistent with this idea that we had to reduce our exposure to carbon risk, and how we could seize the opportunity associated with also this transition, because there is a downside risk, but there is also the risk not to seize the opportunities coming with the transition. So it was exactly what Mats described previously.
Great. So Jan, I want to get you into the conversation, even though you're not speaking from the pension fund perspective, but you were co-founder of a very large private equity fund. It seems to me you could have attempted the strategy that you are now doing at Trill Impact there, but you decided not to do that. Can you tell us a little bit about why?
Well, let me say, I love EQT and I admire EQT. I wouldn't like to criticize anything that EQT does, but I do think it's more difficult to start with an existing asset manager and investment manager, because the mere fact that money rules in the financial world. And currently the funds that are being raised is sort of 10 billion euro each if you invest in an impact investing fund. The largest one was TPG at 2 billion, and typically you don't raise more than $1 billion.
Yeah.
So you won't have the same kind of say in an organization like that. The other is where you're coming from. There are 300 investment professionals, 4 people on sustainability, And by that, EQT and Partner Group are leading in Europe on responsibility investing. So it's a completely different mindset. So I think it's easier to do it outside, although I do believe and hope that all the investment houses will move in this direction, because it will be required. And I personally think that the way to succeed with this, and I think, and I'm convinced we can make money in this, most in the financial community are not convinced. I think I have credibility with that community, so I can go out there and hopefully they'll have some trust I won't, lose their money completely. But I do think we saw the Secretary of Environmental Affairs here today, and I am sorry if I offend somebody. Do you really think politicians will solve this? We got 0 answers. This will come from consumers. This will come from universities. And I think it's utterly important we give people hope, because I think that Johan Rockström here, for the people who believe, you sort of get a bit depressed. Because there are so many people don't believing, and we won't convince everybody. But the universities, there is a movement, and it will affect all of us, because when you negotiate with your kids, you're pretty soft. So they will change the world, and they will require, what do you do with the invested capital? Is it making the world a better place to live in? And I think we can ask that for all of us, because lots of people go into passive investing. And then they support oil and carbon and betting and tobacco and lots of stuff that they don't really sympathize with. We got to change the mindset. But the good thing is, a little 16-year-old like Greta Thunberg, she has more than 1 million followers on Instagram. Swedish Prime Minister had 46,000. I mean, my 10-year-old is playing Fortnite, which is depressing me because it's way too much. But if you think about it, that program, that game was launched 25 of July 2017. 2018 made it $2.5 billion in profits, and 2019 will be much better. And virtually every single 10-year-old on the planet that can read knows about Fortnite. Can you imagine the tools we have at our hands if we do good stuff? This 10-year period is doable. And if we actually use the new tools, the new technology, the infrastructure, it can easily be done. But it's a mindset, and we all have to take a lot of fights, because there are so many non-believers out there, and particularly the people in power, lawyers. I mean, there's no way they're going to do regulation and law in the time we need. Do you really think Trump, Brussels, Putin, and China will solve this? No way. It will have to be consumer-led. And I think that's the way I see it, but I think we will go there.
Hashtag Fortnite optimism. Philippe, then Mats.
Yeah, no, just to rebound on what you said, I totally agree. And to come back to pension funds, someone who is 20, we will manage money for he or for her for 50, 60, 70 years. So for someone who is 20 today, the way we are investing today will determine whether they will get a pension. But beyond that quite challenging target, it will determine also whether they will live in a world in 1.4 degrees more, or 2 or 3. So it means that at some point they will exert pressure to ask managers of pension funds, what are you doing with my contribution? Do you invest business as usual, or do you invest really to speed up the transition? Mm-hmm. And it's where it comes back to governance. How many pension funds have defined clearly what they stand for, what's their policy? And I think that their fiduciary duty will lead them to reset the way they are dealing with that, because they will have the pressure coming from the young contributors that at some point will say, we want to know, you owe us this information. And if we don't get that information, we will sue you. I think at some point, this is what will happen. And for a pension fund CEO, it will be very difficult to say, well, I don't have to provide that kind of information. You don't have to know whether we are more exposed that the index in the oil industry or in or are we invested in the market cap index? Are we replicating? They will ask more information. So I think the movement, the driver will be with the young contributor. I think you're totally right.
Such a good observation about comparing our future to a historic benchmark. The whole question of benchmarks is quite central and insane. Yeah, Mats.
On who's going to solve this, I totally agree that my hope for the politicians is not that high. Private equity, doubt it. From the youth or the next generation, absolutely, it's going to be force. We're forgetting one part of the puzzle, and that is actually pension funds and long-term investors to become owners rather than investors. Yeah. Investors, you come and go. As an owner, you engage. And I think it's unbelievable to see that all the big oil companies owned and dominated on the owner side of institutions, even though we know that 50% of all reserves must stay underground. And I would like to know the book value, number one, on that. Secondly, what do? They continue to drill. How can we as, not investors, but owners, accept that? So if we could get pension funds and the long-term capital to actually engage as owners rather than investors, I think we could have bigger chances of reaching what we should in the coming 10 years.
Thank you. Jan, I want to give you the chance to defend all of private equity. Mats is skeptical of that. What do you see as the greatest challenge, and what is the greatest opportunity that private equity brings to green finance?
Well, of course, private equity is part of the financial industry, and let's face it, the financial industry have never been popular. Since 1300, sort of lending money to people, you'll never be popular. And it will continue. There will be a lot of distrust. So I think it's important that we side, though, because it's a very important part. And unless the private capital changing attitude, we won't get the change. The reason I'm so positive is that I'm personally convinced there is such a tremendous business opportunity, because the change in the consumer behavior and the investments that need to be done, they're not huge. But, I mean, think about it. In my mind, diesel cars, it's game over. I have a hybrid in Stockholm, and I can't charge it today. And 2% of the cars, less is 2%, is hybrid cars and electricity cars. And probably, I asked the CEO of one of the car companies in Sweden, when will be more than 50% electricity cars? Said latest 2025, because 2026, you'll have to cut it in half. So you have to invest more than 10,000 euro in every single sold car to actually solve the carbon issue. So it'll go to electricity. Volkswagen alone is now investing 30 billion. Where are they going to charge? I mean, some of the people will make tons of money on actually providing that infrastructure. And I think we are ahead of the game here. Now the academics at Stockholm School of Economics tell me that if you're ahead of the game, soon the others will caught up, because surely if you make money on it, all the others will move. Okay, fine then. Then we all move. It will be possible to make money on this and even do better returns on this. So in that sense, private equity has a lot of capital. It has the advantage that you question and you take a responsibility. What do you do with the asset? You control the company fully. I mean, I understand some of the old guys, because they think their mandate is their mandate they think is actually managing the share price of that stock. And therefore they say, listen, I'm going to continue drilling, I'm going to continue communicating, I'll hire lobbyists telling we're not so bad. That's their job. But I think we as investors, and particularly the private industry, we can then commit to an agenda and have a positive impact that a lot of people in the public market would just take more time, because the boards and the management teams don't see as their purpose to actually decline their business.
All right, I'm going to give you each a last word, and then we're going to take a couple of questions. So a quick call to action for this audience. If you could urge this audience, which represents a variety of players in the ecosystem, to do one thing, what would it be, Philippe?
Well, I think the most important is to fix this governance issue, because if you don't have a board that is really committed, nothing will follow suit. So governance and how we benchmark our performance. As long as we will stick to the pure market cap, we will replicate what is already existing when we know that we should really invest in something totally different.
Thank you.
I think you should all shoot an email or make a call to your manager of your pension, asking him, how do your money actually contribute to a better world? Mm-hmm. Because it's a good thing that McDonald's and Starbucks quit with straws, but how much do you spend on straw cheese here compared to actually steering your pension capital to something that is sustainable? The effect of almost anything else you do. If you fly a little bit less, if you eat red meat, if you recycle your plastic, your paper, it's virtually, it's 5% of if you actually redirect your entire pension capital sustainable solutions. The impact of that is huge and the quickest thing we can do.
Maybe both and rather than either or. Mats?
I would like to echo Jan. I think it starts with yourself. Get yourself an agenda. And then I would like to end with 3 questions. I mean, what if 30 years from now we're heading not to 1.5 degrees, we're heading to 4, maybe 5, which means a disaster, where it might be impossible to live on this globe. What will you tell your kids and grandkids when they ask you, did you know of this? Did you do anything? Did you have a mandate? Because I think we all have a mandate.
Thank you. That's stirring. We have time for a couple of questions, and maybe there's a microphone in the back so that they can be heard. Yeah, you just raise your hand if you have a question. We'll steer you. Yeah, over here.
Hello, my name is Cosima, and I work for a sustainability think tank here in Berlin. My question was actually raised earlier by one of the panelists, and I think it's a hugely interesting one, and I would like actually for all panel members to answer it, which is, I mean, it's great that there is divestment, it's great that there is movement on the investor side, but what happens when all these divested assets are actually taken up by other actors? Like, is there really a global impact that we see that happens when divestment happens, or is it just a shifting of money, a shifting of opportunities, and someone else is making the money instead of you?
All right, so I'm going to ask you each to address this briefly. What's the mechanism by which divestment works? Is it raising the cost of capital, or does it not really do that? Mats?
I think that there are many ways to answer this question. One is that what an investor or a pension fund does is allocating money from one place to another. And by doing that, they're setting a price on the capital. So if you're not a sustainable company, you will actually have a higher cost of capital and a lower valuation. So you will be hurt. And no one would like to invest in that kind of a company. Then coming back to my argument about governance and being an owner, I think that you start off by engaging, if you can, with an agenda to change things. And I really can't understand if you have a majority that would like to do something, why that doesn't happen. So again, you put different price to the capital by excluding, and start with engaging and see if you can change the board, and hopefully then you have impossible cases. I mean, tobacco. How can you engage on tobacco?
Yeah, great. Mats. Jan?
Well, it's the same thing. The cost of capital will be much, much tougher. And it will also be public pressure from seeing that investors shy away from this product. And if a company loses the faith, then they can actually bankrupt much sooner than what you think. So they may actually go out of business sooner than what otherwise would be the case. And then, of course, if all the pension capital is steered toward companies that are doing good things, there will be good plant eating and plant food and so forth, because they'll get funded. And a lot of red meat companies, they won't be able to market the same way they've been doing before. So there will automatically be a shift here, because the market forces will solve it for us.
Great.
And this is driven by purely economical reasons,
Right.
which is important to say.
Yeah, Philippe.
if you don't want to divest, one way is not to invest in poor companies at the beginning. So already screening in which company you are investing is a way to reduce that risk. And secondly, the problem with stocks is that they don't mature, but bonds do. And if you want to really buy it, you can send a message to some companies and say, we are invested in your bonds. They are maturing in 1 year, and if you don't change, we won't be there to refinance those bonds. Stocks, it's a secondary market. So if you sell, you will have to find a buyer, so you will just shift the risk from one's balance sheet to another. So, you're stuck in some way. But bonds, you have a real leeway.
Let's hear it for bonds. We have time for one more question. Yeah.
Yes, thank you. My name is Heli Antila, coming from Fortum, building their internal startup concentrating on bio-based solutions. And my question is related to technology, new technologies, and how you bring them to the commercial scale. And I have seen technologies that have been there for ages, 10, 20 years, but there has been no capital to bring them to commercial scale. How do you see, is there capital available that is taking also technological risks?
Okay, I'm going to let, who wants to take what swag at this? We get one of you. Yeah, Jan.
Well, EQT raised a 550 million euro venture fund just a few years ago, and that has done tremendously well. I think it's important that some venture capital investment is doing well, because fact of the matter is European venture capital investing has been horrible. Returns the last 30 years is just devastating. So I met with Finnish investors that thought I gave a good story of why technology would matter this time, and he was laughing and he was saying, perhaps it's time to lose some money on venture again. He didn't lose money this time, but I think what we need to realize with the infrastructure investing we made of technology, with the knowledge we're having, with the phones we all have in our boats, with fiber we have at home, the opportunities are tremendous. With artificial intelligence, the game have changed. And I think people need to realize that. I think the younger people realize that more than the elders, because they've grown up with this. It's not the same as it was 30 years ago. And same thing on clean tech. People are very frightened of clean tech. It's very difficult to raise impact fund because people think clean tech, and a lot of 2000 fund failed. It can be completely different in the future, but I think we got to believe it. I personally believe that we underestimate the power of new technology, and not least the positive faith it will give, because I'm very scared of this negativism. It's very dangerous. You got to get people to believe that there is a solution and point to that solution, and then we'll solve it together.
All right, please join me in thanking my Fortnite Optimism panel. Thank you, gentlemen.